Everyone wants to know what interest rates are going to do over the next 12 months. In this video, we're going to unpack some of the factors that are impacting interest rates today and also where they're heading. And we're also going to give you a prediction of what we think interest rates are going to do over the short term and the long term. But before we jump into that, make sure you hit subscribe below to stay on top of all of the latest Huntsville, Alabama real estate news. One of the recent factors that's playing a huge role into interest rates right now is the recent downgrade by Fitch credit ratings on the credit rating of the U.S. Treasury Department and the U.S. government. We were ranked as basically the safest investment in the world at AAA, and really the Treasury bonds has been kind of the gold standard for the world. Everything else is measured against the return of that because that's considered the safest investment in the world. Well, that safest investment has now been downgraded from AAA down to AA+, which doesn't seem like much of a downgrade, but when you're considered the gold standard and gold is no longer 100%, then that is really becoming an issue not only for the US, but really the overall market, and it's impacting interest rates in 15-year mortgages, 30-year mortgages. And the reasoning behind that is that if the credit of the US is no longer is kind of getting a little bit in question, then the cost to borrow not only for the nation, but for individual borrowers within the U.S. is likely to continue to go up because the 30-year mortgage is typically tied to the 10-year Treasury, and if the 10-year Treasury rate goes up, then so do 15-year and then 30-year mortgages. And so this is something that's impacting rates not only here in the short term, but I think this is actually going to be a longer-term impact on rates, really for the foreseeable future until that credit rating goes back up to AAA, if in fact it ever does. So with this recent downgrade by Fitch, it has increased the 30-year mortgage rate from the high 6s to the low to mid 7% range is where we're sitting on those 30-year mortgages right now. So speaking of downgrades, Moody's has recently downgraded 10 regional banks and put several of the big banks on notice that they're on a watch list to be downgraded as well, which to me is just signaling to investors that they are going to be downgraded in the future. So a lot of regional and national big national banks are in trouble right now, and they're in trouble because of their exposure and risk to commercial real estate, which is in trouble and crashing right now. And so a lot of these, especially regional banks, has a lot of risk associated with those commercial real estate deals. And then also basically their ties to Treasury bonds. Treasury bonds are typically the safest investment, and as they loaded up on really ultra low Treasury bond rates, and now that they've gone up, basically as they're trying to liquidate any of those Treasury bonds, the value in those has dropped. And so basically they're getting hit in both directions from the Treasury bonds and the commercial real estate side. And the reason this is important is it's obviously going to affect lending on commercial real estate, but it could absolutely spill over into the residential sector as well, because these banks just have less liquidity, less cash to be able to loan out. That could impact residential real estate, especially on your more bank type products where the bank is lending it in-house, or portfolio type products where they're not selling it on the open market. So this is a factor that we need to keep an eye on long term, because it's going to absolutely affect short-term interest rates and could affect us for the midterm until we get through this banking crisis and commercial real estate crisis. So anytime that we're doing a prediction or wanting to know where the market is headed in terms of valuation or interest rates, it's always a good idea to look at what the smart money is doing. And the Wall Street Journal recently ran an article basically looking at what the smart money is doing, and they drew the conclusion that investors are predicting that interest rates are going to be higher for a prolonged period of time. And the reason they came to that conclusion, and the reason that we can come to that conclusion as well, is by looking at the 10-year Treasury market. So basically, the 10-year Treasury market is a forward look at what investors think interest rates are going to do long term, and the 10-year Treasury rate is actually at a 10-year high now. And so investors are now predicting that those rates are going to be higher for a prolonged period of time, and then the 2-year Treasury rates are starting to decline. So all that packaged together basically points towards the investor, smart money, predicting that interest rates are going to stay higher at a prolonged period of time. And how that translates back to the 30-year mortgage rate is the 30-year mortgage rate is not actually tied to the Fed overnight rate. It's typically more tied to the 10-year Treasury rate. So another factor that I think points towards interest rates staying longer for a period of time is our CPI data. So one might argue, hey, the CPI data came in at 3%. It's down from 9.6% just a year ago. We're at 3%. Fed wants to be at 2%. What's 1% amongst friends, right? But the thing is, the Fed doesn't just want to hit 2%. They want to stay at that number for a prolonged period of time. They don't want to just hit it and then bounce right back up. And the challenge is, I don't know if the Fed realizes this. The real estate industry definitely realizes it. But I bet the Fed is looking at this data as well, that the last time we were in the mid 5% range on mortgage rates, around 5.5%, we had a massive multiple offer situation in this country, homes being bid up in terms of value. And so next time we get to 5.5% with all of that demand that's sitting on the sideline, I think that demand is going to come off of the sideline and go back into residential real estate. And so with that, if we hit 5.5%, I think we'll hit double-digit appreciation in terms of real estate, single-family real estate sales again, in terms of double-digit appreciation in terms of home values. And so if we see that, that would impact CPI data, and then the Fed would have to come back in and start raising overnight rates again. We'd have this massive inflation. So I think this number, this 3% number, and the fact that the Fed wants to keep it at 2% long term, I think we're going to be sitting here at this number for quite some time so that the Fed doesn't see this big spike immediately after. All right, so here's the moment you've been waiting for. My predictions on what interest rates are going to do. I think interest rates will start to stabilize between now and the end of the year, especially in the December timeframe, especially when demand's a little bit lower. I think we'll see that high 6% range return, and I think we'll stay there for a period of time. I do think the Fed is going to pause their interest rate hikes in 2024. Now, if they don't, I think this prediction goes out the window. But if they do pause their interest rate hikes, I think that's going to take a lot of the fear and uncertainty out of the 30-year mortgage rate. And so I think we'll go from the high 6s down to the low 6s. And so I think we'll stay there for a period of time. I think it could be 12 months, 18 months. I think it could even be a couple of years as the Fed tries to get that CPI inflation data down from 3% to 2% and keep it there for a period of time. So short term, I think we're going to see high 6s by the end of the year. Next year, I think we'll see low 6s. And then based on economic data, depending on how bad a recession is or other world events, and as the Fed starts lowering the Fed target rate again, as we start to have a quarter point, a half point rate drops, I do think ultimately we'll see 5.5% rates again. And once we see that, there's so much demand sitting on the sideline. Zillow recently did a poll that 25% of sellers are thinking about selling their home in the next 24 months. So there's a lot of demand sitting on the sideline. So when that demand or when that supply comes off the sideline and the demand comes off the sidelines in terms of first-time home buyers and move-up buyers, and we hit 5.5%, I think we'll see double-digit appreciation once again, not only in the Huntsville market, but across the US.